G'day there. In this video, I'm going to look at the difference between a managed fund and an index fund and why you would choose one over the other. So if you are looking at getting started investing and you're wondering, well, what should I invest in? Then this video is absolutely for you. G'day there. My name is Phil McGilvray. I am a financial coach, financial well-being consultant, and founder of the Money Boss movement, where we make practical, life-changing financial education both understandable and accessible for everyday people. And in today's video, we are looking at what is the difference between a managed fund and an index fund, and why would I choose one over the other. So if you are looking at getting started investing, and this is one of the obstacles that are preventing you from getting started, then hopefully we are going to give you the answer you need so that you can get started investing today. Okay, so there are three really big differences between managed funds and index funds. And these differences are the fund objectives. So what are the funds trying to achieve? The second one is the investment style and strategy that each of the funds adopts. And then the third one is the fees that you pay on those funds. And we're going to go through each of these individually. So let's start with, well, what are the objectives of an index fund? An index fund, the name gives it away, the goal of an index fund, the purpose of an index fund is to replicate the returns of the index that it is tracking. So it is trying to give you the exact same returns as the index. It's not trying to outperform. It's definitely not trying to underperform. It is just trying to track the index itself. And so when we look at, well, what is an index? There are some really well-known examples of indexes. The All Ordinaries here in Australia is the measure of the value of the top 500 shares in Australia. So the top 500 shares listed on the stock exchange, what is the total value of those? And the goal of an index would be to track those top 500 shares. So we've got the All Ordinaries Index, we've got the S&P 500, which is probably the most famous index in the world. This is the top 500 US companies listed on the US stock exchange. We have the NASDAQ, which is the top 100 tech shares listed on the US exchange. We've got the FTSE, which is the FTSE 100, which is the top 100 shares in the UK. We've got the Nikkei 225, which is the top 225 shares on the Japanese share market. And most share markets around the world have their own indexes. And so you will have index funds that will choose a fund, an index, and they will say, we are just going to replicate the return of that particular index because we think that is the best way we're going to give our investors a good, solid, consistent return. So that is the goal of an index fund. Okay, so if we have a look at the objectives of a managed fund, the objective of a managed fund is to outperform their chosen benchmark or index. Where an index fund just wants to replicate the return of an index, a managed fund wants to beat the returns on the index by picking what they believe will be the best performing companies from that index. Now, if we have a look at the second point, which was the investment style or strategy, an index fund is what is called a passive investment because they don't have professional portfolio managers or fund managers or researchers who are trying to pick and choose the best companies in the overall index to try and get better performance. They are simply just tracking the exact same shares in the exact same proportions that is made up in the index. That is their strategy. It is super simple, and that is why it is called passive. An example of an index fund, so if we have a look here, this is the ASX 20 index, so the top 20 shares by capital value on the Australian share market. This is a list of them in alphabetical order, the top 20 shares. So the ASX 20 index fund you can see here, for instance, we've got Amcor, which is a big cardboard box and packaging company. it makes up 1.62% of this top 20 index. So Amcor would be held in the index fund, 1.62% would be held in the index fund of Amcor. If we have a look at ANZ, it makes up 8.27% of the ASX 20 index. So in the index fund, ANZ would make up 8.27% of that portfolio. So it's very, very simple. They're just trying to keep those balances every day. They're basically reweighting the portfolio to make sure that those percentages match up and the exact same shares are in there. So as I said, same stocks, same proportion, same result. That is the goal of an index fund. So let's have a look at the investment style and strategy of a managed fund. So a managed fund is typically considered an active investment simply because it's got portfolio managers that are actively moving shares in and out of the portfolio all the time, because what they are trying to do is pick the best performers. So they have a chosen index that they're trying to beat. They'll look at all the different shares in that index and they will choose what they believe are going to be the best performers. So they have research analysts that go out and they visit these companies. They look through all the company financial reports and so on to try and pick which are the strongest performers, with the goal, as we said, of beating the overall index. An example is this is a real managed fund. In fact, it's one of the best known managed funds in Australia. Its goal here, its benchmark, is to beat the ASX 300 accumulation index. So that's basically the top 300 shares on the Australian Stock Exchange. It wants to do better than that. So it's going to look at that range of 300 stocks and it's going to pick and choose, say, the best 70 or 80 shares in there, hoping that they've got the best ones and they're leaving out the weakest so that they can do better than the index. You can see that the fees here are about almost 1%, so 0.99%, and they call themselves an active fund, and they're fundamentally bottom-up value. So they're picking shares that they think have a lot of upside that are currently just cheap. And then down here, we can see how all their holdings in their portfolio. In fact, this is, just the top 10. They've got about 80 different companies in their portfolio, but these are the top 10, which is very different from the actual index for the top 20 I was showing you a minute ago. So this is what a managed fund will do. They will pick and choose the best performers. Now, if we have a look at the fees, what we've got here is if it was an Australian share managed fund, you're typically paying between about 1% and 1.5% in fees on a managed fund. If we look at an index fund for Australian shares, you're typically paying between 0.1% and 0.3%. So you can see there's a significant difference in the fees. And the reason there's a big difference is because the fund managers have to employ research teams, research analysts to go out and do all their investigation to work out, well, what are going to be the best companies to invest in. Whereas an index fund, all they need to do is just replicate the index. If we look at international shares, this is again more expensive because obviously researching overseas companies can take a lot of time and a lot of energy, a lot of manpower. So international shares, if you're in a managed fund, you're paying between 1.5 and 2% in fees. But if we look at the index funds, again, because they're simply just tracking an index, no research team required, again, the fees are around that 0.1 to 0.3%. So a very big difference between the two. Now, of course, as we said before, you might go, okay, well, the fees are bigger on a managed fund, but then their goal is to outperform the index. So they're going to give you a better return because they're picking the best shares. Now, that would be the assumption. That is what we all assume is going to happen because we're paying more in fees and they're trying to pick and choose the best shares to outperform the index. But here is the reality. If you're in the US and you're investing using US managed funds, over the last 15 years, so this is actually research from one of the biggest investment houses in the US, 84.71% of managed funds in the US, so these are funds that are trying to beat the index, 84.71% of them over a 15-year period could not do better than the index. Only 15.29 actually beat the index. So you look at that and you go, okay, I am paying more in fees, but I'm getting a worse return than I would if I just invested in, say, the S&P 500 index. If we look at Australia, a similar sort of result. 82.16% of professional fund managers, they call themselves managed funds, and their goal is to outperform the index, could not outperform the index over 15 years. 17, nearly 18% could, but choosing, well, which of those managed funds are going to be those performers can be very, very difficult. The reality is, if you just chose an index fund, you would be better off 82% of the time, and that's not including the fact that you're paying more in fees. So the obvious question we have to ask ourselves at this point is, well, why would you choose to invest in a managed fund when it's quite likely that your investment return is going to be lower than an index fund, and yet you're going to pay significantly more in fees? And this is a point that Warren Buffett, one of the smartest investors ever, touches on here, where he says, my best advice for small investors is to put their dough into index tracking funds because of the broad diversification and low costs. And he goes on to say, a very low cost index fund is going to beat the majority of amateur managed money or professionally managed money. So he's basically saying here, go with the index fund because of the low fees, because it's got great diversification, because you're probably going to get a much better return over time than investing in a managed fund. So I hope this has been helpful. If it has, please click on the like button and the subscribe button, because every week I'm releasing videos with practical, life-changing financial education. And I truly believe that little habits, little strategies that you invest in your life now can literally make $1 million difference to your family's future. So please click the like, click the subscribe, and I look forward to seeing you in the next video.